I am not a Swiftie, and I won't pretend to be for this video. But what I will tell you is I am absolutely, incredibly impressed with the impact that she's had on our economy. I'm also impressed with the impact she, Taylor Swift, and Super Bowl 2024 is having on our housing market. And you're like, connect those dots. Well, I want to talk about that because the environment by which the Super Bowl 2024 occurred is the same economy that I've been talking about is too strong to see interest rates drop significantly. Now, it's not to say that I don't think interest rates will drop, but I want to double click on what just happened. Did you know that the average Super Bowl ticket went out for $9,800? The average Super Bowl ticket sold for $9,800. That's mind-blowing. That's like a car. That was up 70% year over year. The United States Chamber of Commerce is saying that we spent $17.8 billion on the Super Bowl. Whether that's the tickets, the food, the drinks, the garb, the gear, all the things. Americans spent $17.8 billion. In fact, we went on to spend $23.1 billion on betting on the game. That's up 44% year over year. I mean, that's disposable income. $600 million was spent by advertisers. $4 million for just a 30-second spot because they believed being in front of you at this game was crucial to their success. 123 million people watched Super Bowl 2024. That's the largest watching viewership of any game, really it's of anything, second only to the Apollo 11 moon landing in 1969. Now, Taylor Swift had something to do with it. Supposedly, she drove 41% of the 18 to 34-year-olds at a value to the game of $12.4 million. And she didn't even sing. She just stood up in the box and cheered. And that was worth $12.4 million. Now, I am in awe. This is amazing. But I've been talking about how strong this economy is, and people want to say it's not that strong. I'm not feeling it when I go to the grocery store because milk and eggs and bread and all the things still cost a lot of money, and they do. And that's where I want to start talking about how does that relate to the housing market. But before I dive in, I have a massive favor to ask. If you dig anything to do with real estate and economics and mortgage lending and how do you start building wealth using real estate, I want to make sure that you subscribe to our channel so you don't miss a beat. And make sure to like this video as well and share it. It helps me reach more people just like you. And honestly, right now, first-time homebuyers need to hear this message more than ever. So let's talk about our economy. Let's talk about what's happening and why is this economy so strong? Because we just talked about the fact that the average ticket holder spent $9,800 for a seat to the Super Bowl. So they've got to be making money, right? I mean, it's not showing up in the savings numbers. In fact, our savings rate is down to 3.7%, but our wages are up. Per the Federal Reserve Bank of Atlanta, our wages are up 5% year over year. Given the fact that inflation is slowing down, that means real wages are up. They're up 1.4%. They've been up for the last 9 months in a row. And this past week, we saw our mortgage rates jump because inflation moved up, which means the cost of everything is still going upward with real wages and with Americans' ability to spend. The CPI, the Consumer Price Index, what we feel when we go to the grocery store, that was up 0.3% month over month. That doesn't sound like a lot, 0.3%, but when you compare it to what we expected it to be, it's a jump up. And the wholesale inflation, the PPI number, that's measuring all the cost of things of getting that goods or services to the consumer, that was up 0.5%. That's a massive jump compared to what we were expecting. So Fed Chair Powell talking about the fact that we don't want to drop the Fed rate yet because we're afraid of inflation going back up. a little bit of that was realized this past week, and we saw mortgage interest rates jump from 6.6 to 7.15. That's real. But as people's wages are going up, they're feeling good and they're still spending. In fact, the GDP, the gross domestic product, expected for the first quarter in 2024 is now showing an expectation of 2.9%. This is after a really strong fourth quarter, 3.3% growth in our overall economy. Initial jobless claims is a weekly data point that shows us every single week how many people are laid off. Everybody keeps talking about the fact that some of these larger companies are laying off 10% of their workforce, 15% of their workforce. But interestingly enough, for the last 3 weeks in a row, the initial jobless claims, which is those people filing for unemployment, was down 7% in the last 2 weeks alone. So if people are getting laid off, they're quickly finding new jobs and they're not going on unemployment. They're still getting those 5% wage increases. In fact, job changers are getting 5.5% wage increases. All of that has the market no longer believing that we're going to see a Fed rate cut in March, which was also part of the reason why our interest rates went up. I mean, Fed Chair Powell said 3 rate cuts in 2024. The market heard 6, and now they're going, we might not get 6. Like, he might have been right. We might just get 3, and they're not going to start as early as March. In fact, just 1 month ago, 77% of investors believed that we'd start seeing Fed rate cuts as early as March. Today, that's less than 10%. Now, 52% believe we're going to see the first rate cut in June. 52% isn't that strong, especially not compared to the 77% just 1 month ago who believed it was in March. So expect that to drop down, and it could be even further out than June. So what does all this mean for the housing market, more specifically for first-time home buyers? Because I started this whole conversation with the fact that Taylor Swift and Super Bowl 2024 is completely correlated to the experience that first-time home buyers are having today. Well, Taylor Swift and Super Bowl 2024 is operating inside a strong economy. Consumers are still spending. They're still feeling good. And right now, remember, a majority of our existing homes are locked in with interest rates under 4%. And as rates jump from 6.6 to 7.15, we have to know that that's going to make it harder for first-time homebuyers to get in. In fact, we've seen the worst affordability we've seen in decades. And so those small movements of interest rates directly impact first-time homebuyers. In fact, when we saw interest rates staying steady at 6.6 for 6 weeks, we actually saw 2024 kick off with 24% more mortgage purchase applications. People were chomping at the bit to get into the real estate market. Now, as we've seen interest rates jump up from 6.6 to 7.15, we saw mortgage purchase applications drop week over week over week for the last 3 weeks in a row. In fact, they dropped as much as 11%. So first-time home buyers, you're operating inside this dichotomy of a strong economy per the data and what we feel is a very hard economy to survive in. I mean, think about this. Our credit card debt is up to a record high of $1.13 trillion with an average credit card interest rate of 22.75. I saw that and I was like, that's the average? So if the average is 22.75, who's got 30%, right? So when you've got those high credit card interest rates and those high credit card balances, and yes, you're making more money, but it doesn't really feel like it, you have this divergence of, do I buy now or do I wait? I mean, it's a political year. The data says it's strong. I'm not really feeling like it's strong. My confidence is up. In fact, consumer confidence is stronger than it's been since July of 2021. But overall, I don't know what to do next. So here's where I want to talk about the first-time home buyer. First-time home buyers, if you want to get in, I'm going to tell you right now is when you should be considering getting in. Now, I'm not going to sit here and talk to you as a lender that I need a transaction, so you need to buy. No, The answer is not that. But if I told you that if you bought into real estate and if you held that real estate over the next 5 years, could you add several $100,000 to your net wealth? I'm going to show you how you can, and how the longer you wait on the sidelines and the longer you pay rent to somebody else, the further their retirement plans get and the further behind yours get. So that's a conversation for another video. But what I want to talk about in this video is first-time homebuyers. The opportunities you have right now are ridiculous. FHA loans continue to grow in their numbers and overall volume because they give access to people who have lower credit scores. So maybe you've got some bumps and bruises and dings. You can still put 3.5% down with an FHA loan and get into a multi-unit. You could buy a 2 to 4 unit property, bringing in rental income while having them offset your mortgage payment, putting only 3.5% down. If you're a veteran, you've got the best loan on the planet with no money down, along with USDA. If you want to live a little further out and live the rural life, you go for it. You're putting no money down. And then conventional's got some really unique products with their Home Ready and Home Possible, giving first-time homebuyers the opportunity to put 3% down. We also have an AMI product, and you're like, what is that? So that's based on the area median income. Did you know in Denver, if you make less than $150,000 annual income, and you're like, well, I make 125 and my spouse makes 125, so we make more than the $150,000 a year, but maybe I don't use you both. Maybe I just use one of you. And if you make less than $150,000 a year, you actually get a lower interest rate and lower mortgage insurance, and you can still put minimum down. I mean, do you know about all of these loan programs that get you in with the least down with the lowest interest rates? And you can even use rental income, not just for a 2 to 4 unit, but I'm seeing more and more single family homes get listed with auxiliary dwelling units, or those little tiny homes in the backyard. I can use rental income from that auxiliary dwelling unit. And then I want to double click on probably one of the best loan programs out there that people aren't talking about. And it's called a renovation loan. You're like, that sounds like work. Okay, it is. It is work. That's the whole idea behind a renovation loan. But do you know that right now, here in the Denver market, we have 75% more inventory than we did in 2022? And people keep talking about the fact that we don't have a lot of inventory out there. As new listings come out, they're immediately getting scooped up with multiple bids and over asking. But there's still inventory out there. It's just not the inventory that has that beautiful curb appeal. So it's not getting scooped up. In fact, right now, we're seeing more investors come in and fix and flip homes, selling you that perfect home after the fact. But you could do your own work. You could hire a contractor and have it be the perfect home built just for you with a renovation loan. If you don't know a lot about them, we need to talk, because you could put as little as 3% down and build the home exactly the way you want it. And there are 29 down payment assistance programs just right here in the state of Colorado. So anybody that tells me that I don't have enough money to put down so I can't possibly buy a home hasn't talked to me. There are 29 down payment assistance programs. And this is in addition to everything else that I love to do sitting down with our first-time home buyers. Whether it's talking about your entire strategy and what you need to implement in order to, if not now, when, the 2-1 or the 3-2-1 buy down strategy that scoops up additional funds for your refinance and ultimately gives you a lower monthly payment. Or how about the fact that you can't afford your perfect home, so you're going to afford your perfect investment strategy? All of these things, talking about first-time home buyers, is talking about the fact that we do ultimately have a strong economy. We have an economy where people are not hesitating to spend the money on the things that they think are worth spending it on. That they'll spend $9,800 on a Super Bowl ticket or $50,000 over asking on that perfect home. We will see home prices continue to go up, whether interest rates go up or down. And here's the kicker. When interest rates go down, we've already seen it, We saw 2024 kick off with 24% increase in mortgage purchase applications. The moment we see mortgage interest rates drop, we will see more demand come out. So you as a first-time home buyer have to break through the fear and the headlines and get to the strategy, the budget, and the ideal path for your specific financial situation. This is your solution, not somebody else's, and certainly not the headlines and not the be-all end-all. This is for you right now, first-time home buyers, because if we're actually living inside the Swifty world, we're living inside a world where people are spending money and feeling that it's a strong economy. Right now is a time where you start building your own net wealth. Because if in 5 years' time, you can buy a median price point home here in the Denver market and experience an average price growth of 6%, yielding you over $225,000 of net wealth, then I'm going to tell you that right now might just be your best time to buy. And if you're not working with a great lender or a great real estate agent, we've got your back. Not only would we love to support you with your lending solutions, but I've got phenomenal partners, that real estate agents that care deeply to ensure their client success. So make sure to give me a call, DM me below, or comment. We'd love to go to work for you.